To give us his view on the global market space and all those factors that Dumisho just highlighted a moment ago, I'm joined now in Cape Town by Graham Bell. He's from Old Mutual Equities. Graham, it's always a pleasure to speak to you. Let's pick up on the key considerations that Janet Yellen and her team need to take into consideration. Dumisho alluded to the very strong dollar that we've seen in the last few trading sessions, the slump in the oil price, and that P word, patience. It's nerve-wracking slightly as to understand what the ripple effects might be, not only for the equities market, but for emerging markets as well, like South Africa.
Hi there, Gugu. Yeah, so the first thing to remember is that the Fed, Janet Yellen and her colleagues, don't have any more insight into how the economy is going to unfold than loads of other economists around the world. So they're just human beings like the rest of us. So the key word, as you say, and everybody's focusing on the word patience, and at some point during the presentation by the Fed, we'll know whether that word is going to be there or not. Chances are it's probably going to disappear, but then she has to take a whole lot of other things into account. And as you mentioned, the dollar, it's not just the last few sessions the dollar's been strong. The dollar has been through one of the most sustained periods of appreciation against the euro in a decade. It's been really, really strong against a basket of currencies as well. And that's been continuing recently. And what that does is it transmits the deflation that's been taking place in the other parts of the world into the USA. And so you've seen wage rates decelerating. You've seen headline inflation coming in actually negative last month. Even the core inflation rate's been coming down. And if you look at economic activity, it's not just the retail sales industrial production that you mentioned, but in fact, for over the last several months, the economic surprise index for the US has had the sharpest fall in 4 years. It's really plummeted. So a lot of data has been coming in below expectations. And the Fed has to take that into account. So what we may well see is that Yellen drops the word patience in the Fed statement, but then in the press conference, she might well allude to the fact that the dollar has been strong and that there are other issues that she needs to take note of. So it's not going to be a sort of a slam dunk, open and shut case, patient goes, therefore, sell everything, the dollar's going up. It'll be a lot more nuanced than that. But the one thing we can definitely say this year is that at some point it looks likely that the Fed's going to hike. And in the run up to that, the volatility in markets is going to continue to pick up. And it's not just that we're looking forward to increasing volatility. We can already look back to a significant increase in volatility in recent weeks. As you know, the Rand just 2 weeks ago traded as low as 11.30. 11.35, and just the other day, a few hours ago, it was well over 12.40, even touching 12.50. It's come back a little bit since then. So that volatility has already been taking place, and it's likely to continue.
For the equity investor, what does this mean then? Does it mean that stick to your guns and your investment decisions and choices and don't react significantly to the noise?
So yeah, Gugu, I know month after month we've talked about this, and I've generally taken a pretty positive line on equities. I still do that. Obviously, one's got to select in the right areas, the right sectors in the economy, in the market, and particular stocks and so on. But generally speaking, yes, I think global economy is still rising, even if the Fed hikes this year. And whether it's in June or September, wherever it is, the interest rates are still going to be extremely low. I mean, there's only 0.25% at the moment. 0.25% is nothing. If it goes to 0.5%, 0.75%, 1%, that's 3 rate hikes, still very, very low. And in the meantime, you've got massive intervention by the European Central Bank and the Bank of Japan, buying assets, and interest rates are negative in Europe in particular. So yes, it's not going to be an easy ride. It's not open and shut again, but yes, I think equities are still a place to be.
Let's move our attention onto the UK, where I understand that they are expected to raise their minimum wage by more than inflation, significantly higher. It is a unique position in which the UK economy is in, because it's obviously in the middle of the drama that's unfolding alongside it in the Eurozone, where we know that quantitative easing has recently been established into the system.
Yeah, well, UK, as you mentioned, there's talk now that they may not hike the rates this year. If you remember, a lot of the time during last year, the expectations were that they would be the first to hike. They're now backing off from that position. Wages looked like they were starting to accelerate last month, but the latest numbers show that actually that's not really the case. They seem to be wages seem to be kind of backing off again. And in addition, the complication is that there's an election in May where it's by no means certain that the Tories are going to win, but also we have no idea what other parties are going to feature. There's a whole lot of other potential players. So it's pretty uncertain how things are going to turn out. But UK economy has been chugging along quite nicely. The pound has fallen quite sharply against the dollar, although it's been strong against a lot of other currencies. And I think for the time being, the BOE just stands pat and watches. And you know, maybe the Fed will in fact end up being the leader after all.
Graham, just to close off with the oil price is obviously something as well that has been taking a bit of a hit as well. Last I saw it was at $53 a barrel. Again, this certainly does raise concerns from a global perspective. Maybe in South Africa we won't be complaining too much because it might lighten inflation.
Look, net, falling oil is positive for the world economy. There are far more consumers than producers. So consumers are beneficiaries around the world, and retail sales around the world, generally speaking, will benefit. The big thing with oil is there are two big things to watch. The one is the phenomenal increase in stocks. In the US, you're seeing inventories rising week after week after week to record levels. And the other side of it is this dramatic decline in the rig count, the number of rigs exploring for oil, particularly in the USA. So these are two things moving in opposite directions. And at the moment, the massive oil stock, increase in oil stock, is dominating the picture, the market picture, and that's pushing prices down. But at some point, these lower prices are going to cause, and expressed through the rig count, for instance, are going to cause supply to start pulling back. And that will be the point at which the oil price starts to bottom out. But we're not there yet.
Graham, thank you so much for your time today and analysis of the global market space. That was Graham Bell, who's a strategist at Old Mutual Equities.